So you must have heard the introductions. Our panel includes people who are managing single family offices, some of the most successful family offices, people who are running multi-family offices. So I think we'll have a very broad spectrum of thoughts. So I'll not waste any more time, and I'll start shooting questions at the panel. My first question is, how would you, I would, let's get to the practical aspects. This is the kind of things we need to have in our mind. But the practical aspect is you can just easily classify your assets into some income generating assets and some growth assets primarily, right? Depending on the family's circumstances. So how do you do that, and then what do you look for when you want to have income generating as opposed to growth? Bennifer, you want to kick off?
Sure. So thank you so much for the introduction. And I think on the income and growth side, on both sides, families have requirements which are varied. I think it's, I can talk about the experience that we have with our family. So much so that for income side of the business, or when you want to generate asset, returns on the income on a consistent basis, I think debt is the asset class that we look at. On a consistent basis, based on the risk return that we have determined for our internal purposes and the process that we've set, we look at varied options from liquid markets and options available there. On the mutual fund side, to you have, of course, the more sophisticated products available, which do promise a monthly kind of base. As far as growth assets are concerned, for the Patni Group, what we look at is kind of identifying companies or young entrepreneurs to kind of seed them, get into an early stage where we get much more hands-on involved with them, and drive the treasury towards a growth phase.
I see. So it's on the one side it's very liquid assets, and on the other side it's the what we call the alternatives. Yes. And even there the most aggressive part of it.
That's right.
Right, which is the seed and
yes.
angel and venture kind of.
Yes.
Dinesh, would you like?
Sure. In my experience, those who are interested or have set up a family office have assets such that the income producing element of it is very modest. I mean, in other words, they want some income, but relative to the income that they want from their financial investments, relative to the size of the corpus, is insignificant. Okay. And so, there's sort of a continuum, and that continuum is everything from, hey, let's go put some into government-backed debt, which is safe, we know we're going to get it, sure, to a continuum which says, do we go all the way up to lending to real estate developers at obviously much elevated rates of interest, with therefore some credit risk and maybe some uncertainty about exact cash flows. But as I said, in my experience, people who have sufficient capital to be thinking about a family office, the income part is really not, it's almost like a rounding error.
Oh. Prakash?
Yeah, but because before we talk specifically on the investment aspect, you elaborated that so well. I just like to step back a bit and go on to this philosophy, policy, process part. And then from our experience managing multi-families, not just one family office, this is an error that tends to happen very naturally. People tend to gloss over the importance of these things. Mm-hmm. And let me also de-jargonize this whole thing, because it's not as complex as it sounds. I mean, we need to win our bread, so we make it complicated. But ideally what works is the philosophy explains the whys, the why nots, the whens, the wheres of what a family sees its wealth portfolio to go to. The processes define typically what's going to be done. The policy decides what's going to be done, and the processes will explain how it's going to be done. So it's a very simple but very, very critical element, which is more like a overarching statement that the family needs to define. Some of them call it the family investment charter. And our experience is families trying to say, oh, okay, let's get, this is fine, we know where we are, and So the challenge is more for people who have already begun investing. There was a significant size that the portfolio has grown to. And now you're kind of sitting back and saying, hey, are we doing the right things? So this is where the investment philosophy, policies and the processes are very quintessential to be defined. And as I said, it's a lot of jargon, but it typically is akin to a vision statement which has to define clearly, articulate very clearly what the various segments of the family and stakeholders need to benefit out of. And then, of course, you'll have the income and the growth flowing out of it. So I would believe most wealth managers are challenged by that aspect. Families tend to spend less time on it. Wealth managers probably aren't able to probe enough to define that. But that's a process that takes a long amount of time.
So yeah, I mean, that's actually the most important part. Why investment philosophy comes into play at all is because investments are uncertain. If there was no uncertainty, actually we would be able to do away with philosophy. It would be a pure operations aspect where you just pick assets and you get the returns on a time-bound manner. But because things are uncertain, because you don't know what is going to happen, all the value is in the future. That's where the philosophy comes in. That's where whether you believe people can forecast, whether you believe we have to look at the trend, whether you believe what is proven in the past, whether you believe something called value, where you believe that there can be difference between price and value. So all these questions are there. I didn't put them in the talk because that will become very heavy. The practical aspect of how you use it daily is, I think, that's the most important thing we can share here.
Yeah, and just to add to what I mentioned, it's not about absolute returns that a family would need. I mean, every family has very clear and very defined kind of objectives. And you remember, you're not talking about financial planning, which most people get mixed up with. You're not talking about your daughter's wedding and your next vacation. I mean, this is a perpetual portfolio that has to deliver when it has to deliver. And there are extremes that we've seen. There are people who are extremely conservative about the portfolio where they just don't want to lose a single rupee out of it. And a majority happens to be that segment. Whereas there could be families which are willing to take an extreme level of risk. And very clearly you need to kind of understand that. And that's what the philosophy was, that's the charter needs to articulate. Because this is where you go back to evaluate yourself all the time. This is where you check out whether a product fits the bill or not. This is where a wealth manager needs to get very clearly calibrated on. So I think the practical aspects are what probably are missing because it's a nascent business of sorts right now.
You want? Just to add to that, again, in my experience, there are two areas that perhaps people aren't as focused on as they should be. One is when you say, well, I'm willing to take risk or not willing to take risk, what really does that mean? Risk can be defined as an absolute loss. That's the most obvious. Right. But I think more important than that is your ability to take a drawdown, right? Because that is really what happens is, especially in equity, where, as you've seen, it is volatile, but if you hold it long enough, you usually end up ahead. I'm talking about at portfolio level, not an individual stock. And so, helping people think through that, I think, is absolutely key. And there's no right answer, right? So one person may say, well, and in a sense, you've got to put it in hard numbers, because you can show them data that says that, in a 1-year period, you could lose 40%. Right. But if you hold for 5 years, and this is your probability of recovering and making money and so on and so forth. But these are abstract numbers. When you start putting it into hard numbers and saying, you're going to put 100 crores into equity today, right? And these are real numbers. And you could be down 40 crores in 3 months. But if you hold it, this is what's going to, not that the past is a perfect predictor, but it has some semblance. Absolutely. If you believe in reversion to mean. Absolutely. And so that's the kind of thing that I think, needs to be brought out more. Is risk as defined by drawdowns.
By a amount, by
a
quantum.
and saying, first of all, what is your tolerance? And I don't think that can be answered in one afternoon session, right? I mean, it's not, let's sit on a blackboard and sort this out. They have to internalize it, socialize it, think about it, and there's no right answer. You may tell me, I can handle 20 crores, somebody else may say I can handle 50 crores, so it's your choice, it's a personal choice. Right. The only thing you can point out is that there's a cost benefit to that, meaning if you don't want to accept drawdown, then by definition you're going to put less into risk assets, and therefore your returns will suffer over a period of time. The other aspect is the value that you need to put on illiquidity. And particularly in India, I think, where there's been this history of investing in real estate, for a lot of families that's been the safe asset.
Absolutely.
And so you will hear about how, you know, I bought this land 20 years ago for X and is now worth Y. First of all, I don't find that they go back and actually look at what does that translated into a IRR, right? And usually that number is far less modest than what they think it is. And secondly, you say, well, in that period, you know, did it just go straight up? And then they say, no, not really. There were long periods where actually, you know, it went nowhere or went down. And then the other question is liquidity, meaning if you really needed the capital, would you have been able to sell it? And I say, no, actually, no. There was a period where we wanted to and we needed capital, but we couldn't get out of it, you know. And so liquidity is something that I don't think people factor in, saying, am I being compensated for that lack of liquidity?
I'd just like to add to Prakash's point. I think a lot, and I completely agree with both of you, that initially a lot of time goes into actually charting out what are the rights and the wrongs, what are the do's and the don'ts for each and every sub-portfolio that you're going to look at, with a lot of holistic view in mind, as in what you want to achieve. In my experience, that has been you know, a very exhaustive process. Also, what comes about is that though you've charted down and you've laid out a philosophy, it's time and again that you have to realign expectations with the actuals of how liquid markets or illiquid markets are running at that point in time with the perceptions. So I think the biggest challenge of a family or a family office is to maintain track, and maintain track on the one you've set for a medium to a longer term horizon.
Another interesting trend which I wanted to have a discussion is globally, if you see, the family offices are very much focused on preserving the capital.
Right.
But why, what I see, and you just gave your asset allocation broadly, it's the dumbbell asset allocation, which is called, which is one side it's extremely risky assets like seed, and on the other side it's liquid. Okay, so that, as opposed to, and I see this with many probably first generation of people who've created a lot of wealth through, and many of them are IT founders, and they, all of them, all are of course at a very strong working age where they can contribute to things like venture capital or the new people who are trying to strive up. And then that trend I see in India, I have not seen that in the global family offices. There the trend is more preservation, low risk. So can you just talk a little bit about it, and then others can.
I think globally, whatever interactions that I've had with family offices suggests that you know, the mandate is left to the family office at all points in time. The multi-family offices there are more like pooling vehicles which run on mandates. Unlike the domestic context, I think Indian families are more, wish to be more hands-on into the wealth that has been created. They also alternatively believe that as they have grown as entrepreneurs, which is actually the case in India, is a nation of entrepreneurs, there are enough and more ideas which can be backed if they have the right business plan and the right models to go ahead. And there's also a lot of lack of direction on, because there are no really institutes feeding these younger breed of promoters.
Absolutely.
So I think it's fairly different from the global context, because you know, the way international family offices are run are more asset allocators, more productized approaches, and more interested in saying that you know, this is the return that we want to work towards. I'm giving you the authority, do what you feel is like, choose the right markets, and then probably allocate those assets.